Welcome to our trading journey. Before we dive into the essential trading terms for beginners, let's explore an advanced concept that every trader should understand: market volatility. Volatility refers to the degree of variation of a trading price series over time. In simpler terms, it measures how much the price of an asset bounces up and down. High volatility means the price of the asset can change dramatically over a short period in either direction. This is often seen in markets driven by news events, economic data releases, or unexpected occurrences. Think of it like a roller coaster ride, thrilling but unpredictable. On the other hand, low volatility means that the price of the asset does not fluctuate dramatically, but changes in value at a steady pace over time. This is more like a smooth, scenic drive through the countryside, calm and consistent. Understanding volatility is crucial because it helps traders manage risk and make informed decisions about when to enter or exit a trade. So keep volatility in mind as we move forward. Now let's dive into some essential trading terms for beginners. Historical volatility is a measure of how much the price of an asset has fluctuated in the past. It is calculated by looking at the asset's past price movements over a specific period. This helps traders understand the asset's past behavior and predict future price movements. Implied volatility, on the other hand, is a measure of how much the market expects the price of an asset to fluctuate in the future. It is derived from the prices of options on the asset and reflects the market's expectations. Understanding both historical and implied volatility can give traders a more comprehensive view of the market. This knowledge can help traders make more informed decisions and better manage their risk. So, as we move forward, keep both historical and implied volatility in mind. Now let's dive into some essential trading terms for beginners. Now that we understand market volatility, let's move on to another crucial aspect of trading: liquidity. Liquidity refers to how quickly and easily an asset or security can be converted into cash without affecting its market price. Imagine you're at a busy market. High liquidity is like having a product that everyone wants and can easily buy or sell without changing its price. This ensures that transactions can be completed smoothly and efficiently. On the other hand, low liquidity is like trying to sell a rare item in a small, quiet town. It might take longer to find a buyer, and the price could fluctuate significantly as a result. In trading, high liquidity means that an asset can be bought or sold quickly without causing a significant impact on its price. This is essential for traders who need to enter or exit positions swiftly. Low liquidity means that buying or selling an asset can have a significant impact on its price, making it harder to execute trades at desired prices. Understanding liquidity helps traders choose the right assets to trade and manage their strategies more effectively. So, as you embark on your trading journey, always consider the liquidity of the assets you're interested in. It can make a big difference in your trading experience. Now let's dive into some essential trading terms for beginners. Now that we understand the importance of liquidity in trading, let's delve into the different types of trading orders. Knowing how to place the right order can significantly impact your trading success. First up, we have the market order. A market order is a buy or sell order to be executed immediately at the current market prices. Imagine you're at an auction, and you're willing to pay whatever it takes to win the item. As long as there are willing buyers and sellers, market orders are filled. Market orders are the most common type of order because they are the fastest and simplest way to get in or out of a trade. Next, let's look at limit orders. Unlike market orders, limit orders allow you to specify the price at which you want to buy or sell an asset. Think of it as setting a budget for your auction bid. You only win the item if the price stays within your budget. This type of order is useful when you want to control the price at which your trade is executed but are willing to wait for the right conditions. Another essential order type is the stop order. A stop order becomes a market order once the asset reaches a specified price. It's like setting an alarm clock. When the price hits your target, the order is triggered. Stop orders are often used to limit losses or protect profits. Lastly, we have the stop limit order. This combines the features of both stop orders and limit orders. When the stop price is reached, a limit order is placed instead of a market order. It's like setting your alarm clock to go off only if certain conditions are met, giving you more control over the execution price. Understanding these different types of orders can help you execute your trading strategies more effectively. Choose the right order type based on your trading goals and risk tolerance. Now let's move on to some essential trading terms for beginners. Now that we've covered the basics of different trading orders, let's dive deeper into one of the most crucial types: The limit order. Understanding limit orders can provide you with better control over your trading strategy. A limit order is a type of order to purchase or sell a security at a specified price or better. Imagine setting a price ceiling or floor for your trades. For a buy limit order, the order can only be executed at the limit price or lower. Conversely, for a sell limit order, it can only be executed at the limit price or higher. This ensures that the trader gets the price they want, but it may not be executed if the market does not reach the limit price. Think of it like setting a reservation at a restaurant. You specify the exact table you want, but if that table isn't available, you're willing to wait rather than settle for another option. This type of order gives you more control over the execution price but requires patience, as the market conditions must align with your specified price. Using limit orders can be particularly advantageous in volatile markets, where prices can fluctuate rapidly. By setting a limit order, you can avoid the risk of buying or selling at unfavorable prices during sudden market movements. However, it's essential to remember that there's a trade-off. While you might get the price you want, the order might not be filled if the market doesn't hit your target. In summary, limit orders offer a balance between control and patience, allowing you to manage your trades more strategically. By incorporating limit orders into your trading toolkit, you can better navigate the complexities of the market. Next, let's move on to some essential trading terms for beginners. Finally, let's talk about short selling. Short selling is the sale of a security that the seller has borrowed. A short seller profits if a security's price declines. However, if the price of the security rises, the potential losses are unlimited. Short selling is a risky strategy and should be used with caution. When you short sell, you're essentially betting that the market price of a security will drop. You borrow the security from a broker and sell it at the current market price. If the price drops, you buy it back at the lower price, return the borrowed security to the broker, and pocket the difference. But here's the catch. If the price of the security rises instead of falling, you will have to buy it back at the higher price, leading to potentially unlimited losses. This is why short selling is considered a high-risk strategy. It's like borrowing a luxury car, selling it, and hoping you can buy it back at a lower price. If the car's value increases, you could end up paying a lot more to get it back. Short selling requires a deep understanding of market trends and a strong risk management strategy. It's not for beginners or the faint-hearted. Always consider the potential for significant losses and use short selling sparingly and wisely. In summary, while short selling can offer substantial rewards, it comes with high risks. It's a powerful tool in the trading arsenal but should be wielded with caution and expertise. Now, let's move on to some essential trading terms for beginners. If you found this video helpful, don't forget to like, subscribe, and comment below with any questions. Happy trading! Hey there, future traders! Ready to dive into the exciting world of trading? Today, I'll break down some essential trading terms every beginner needs to know. Let's get started. First up, we have the bid is the highest price a buyer is willing to pay for a stock. Think of it as the buyer raising their hand saying, "I'll give you this much." Next, the ask is the lowest price a seller is willing to accept for a stock. It's like the seller saying, "I'll sell it for this price." Now, let's talk about the spread is the difference between the bid and the ask price. For example, if the bid is $10 and the ask is $11, the spread is $1. This is essentially the cost of doing business in trading. Moving on to leverage allows you to control a larger position with a smaller amount of money. It's like borrowing money to increase your potential returns. But remember, it can also amplify your losses. Speaking of money, let's discuss. Margin is the money you borrow from your broker to trade. It's like putting a down payment on a house while borrowing the rest. Always be cautious with margin, as it can lead to significant gains or losses. Lastly, we have a stop loss is an order you place to sell a stock when it reaches a certain price. It's your safety net to limit potential losses. For example, if you buy a stock at $50 and set a stop loss at $45, the stock will automatically sell if it drops to $45. And there you have it. 6 key trading terms simplified. Remember, understanding these basics is crucial for your trading journey. If you found this video helpful, don't forget to and below with any questions. Happy trading!